All right, let's get right into it. We all have savings, but here's the big question. Are they in the right spot? Today, we're going to break down the big showdown between high-yield savings and money market accounts to figure out, once and for all, the best place for you to park your cash. So, why does this even matter? Well, this number is why. 250 bucks. That's how much you could be losing out on every single year on a $25,000 balance just by picking the wrong account. Yeah, it seems like such a small decision, but it has a real, actual impact on your money's growth. So in this explainer, we're going to unpack that hidden cost. We're going to give you the clarity you need to make the smarter choice. To do that, we're putting these two accounts right up against each other, head to head. We'll be looking at three really crucial differences between a high-yield savings account and a money market account. We're talking rates, access, and of course, the rules. First up, the one everybody cares about, interest rates. High-yield savings accounts, or HSAs, they almost always pull ahead, usually offering yields in that 4 to 5% range. And a big reason for this, they're often from online-only banks that have lower costs, so they can pass those savings on to you. Money market accounts, or MMAs, are usually just a little bit lower, sitting around 3.5 to 4.5%. And trust me, that little gap can really add up. So let's put some real dollar signs on this. On a $10,000 balance, that 1% difference means you'd earn an extra $100 a year in the high-yield account. And the more you save, obviously, the wider that gap gets.
Okay, so you're probably thinking, why would anyone choose the lower rate then? Well, it really just comes down to one word: access. Money market accounts kind of act like a hybrid between a checking and a savings account. They often give you a debit card and even checks. HSAs, on the other hand, are a bit more of a fortress. You usually have to transfer the money out to a different account before you can spend it.
But here's a thought, and it's a little counterintuitive. Maybe that lack of easy access is actually a feature, not a bug. See, by making it just a little bit harder to get to your money, a high-yield savings account creates this, psychological barrier. It helps you fight that temptation to dip into your savings for stuff you don't really need. And the third big difference, it's all about how easy it is to get started. HSAs, especially the online ones, are incredibly easy to open. A lot of them have no minimum balance requirements at all. MMAs, though, can sometimes be a little more exclusive. They might require a higher balance just to open the account, or to make sure you avoid monthly fees. Okay, so we've looked under the hood, we've seen the specs. Now for the most important part. How do you choose the right tool for your financial goals? Because it's all about building a personal strategy that actually works for you. A really great way to think about this is like picking a car. The HYSA, that's your super fuel-efficient model. It gets you the best mileage on your money, maximizing your growth, but it might be a little light on the bells and whistles. The MMA, that's more like a fully loaded SUV. It's got all the conveniences like a debit card and checks, but you pay for it with slightly worse gas mileage, or in our case, a slightly lower interest rate. So for your emergency fund, the money you want to grow but absolutely not touch, the HYSA is the clear winner. You get that higher rate and that protective friction, but for short-term goals where you need some flexibility, like saving for a vacation or a down payment you'll need soon, the MMA's easy access might be worth that little trade-off. And hey, if you're just starting out, the HYSA's low minimums make it the absolute easiest way to get in the game. But hang on, what if you don't actually have to choose? What if this is a false choice? The real pro move here is to realize you can actually use both of these accounts together to create a way more powerful and flexible savings system. Here's how it works. It's super simple. You use the high-yield savings account for your main long-term emergency fund. Think of it as your savings fortress, where your money is growing untouched. Then you use a money market account for your more active short-term goals. This gives you the flexibility to pay for things directly from savings when you're right. It's really the best of both worlds. Now, after all this back and forth, we've got to talk about the single most important move you can make. And I promise you, it might not be what you think it is. So here's the thing. It is so easy to get stuck trying to find the one perfect, absolute best option. But getting frozen by what they call analysis paralysis, that can cost you way more in lost interest than picking the, quote, wrong account between these two really great options. Because here's the bottom line. The real victory here is not choosing between 4.5% and 4%. The real win is choosing either of them over the 0.01% you're probably getting in a traditional savings account right now. That is where the real life-changing difference is. Moving your cash out of one of those accounts is like going from walking to hopping in a car. So As we wrap this up, here's the final thought. You have the information now. You know for a fact that your money could be doing more for you, growing faster, getting you closer to your goals. So the only question left is, what's your next move?